These and all other managerial accounting problems can be found in Sarai's studies. The link is in the description box below. The following data relates to Jake from State Farm's company in the year 2021. So we're given a bunch of data and we're asked to find all of this stuff here. As soon as you see a bunch of costs being listed, especially when you see the word inventory and dates, and especially if you're being asked things related to the inventory accounts, remember that the inventory accounts are direct material, work in process, and finished goods. And here we see direct materials, we see work in process, and finished goods. Just know that you have to pull up the inventory system. And then cost of goods sold, we add that at the end. But really, your three inventory accounts are these. So everything has a beginning inventory and ending inventory if it's a inventory account. But cost of goods sold, because it's not an inventory account, has a beginning balance and an ending balance. Every account has something that increases it, and every account has something that decreases it. What increases a direct materials account is more materials. So we're going to say purchases of direct materials. What decreases it would be usage of that material. Whatever we're in the process of using goes under direct materials in the work in process account because you're currently in the process of using that amount worth of direct materials along with the direct labor and overhead, manufacturing overhead. And so what decreases the work in process account is the worth of the goods that are not in the process of being made. That's cost of goods made or manufactured or produced. And if you're done with those goods, then they go into finished goods because you're done with them, right? They're made. And they go here as cost of goods available for sale, or as Sahay says, gas. And then what decreases the finished goods account is goods that are sold. So that goes under cost of goods sold and cost of goods sold. So let's plug in what they give us. Direct materials beginning inventory, because I see January, is $0, meaning this is probably a new company. They start at zero. Direct materials purchased is $200. So remember, everything is in terms of dollars. Direct materials used is $100, meaning that we're in the process of using $100 worth of direct materials. I'm just going to plug in things that are straightforward. So work in process inventory in the beginning, because it says January, is $0. Cost of the goods completed, that's $200. Completed is the same thing as made. It's the same thing as manufactured. It's the same thing as produced. That's over here. That means that cost of goods available for sale is $200. Beginning finished goods inventory is $0. So they have $0 worth of finished goods. And then cost of goods sold is $100. Now the direct materials account we can figure out. Add the debits. That's 0 plus 200. That's 200. Debits and credits have to be same. So 200 minus 100 is going to give us 100. So ending direct materials is 100. Now what I like to do is I like to fill in everything first and then answer the questions. I feel like that's an easier approach. So this is 100. I'm going to do that because this one's like just very straightforward. But really, I fill out everything. So let's go ahead and do that. They're telling us that total manufacturing cost is $1,000. So pull up the chart. Remember that manufacturing costs are made up of direct material costs, direct labor costs, and manufacturing overhead costs, or just overhead, same thing. Direct materials is always going to be variable as well as direct labor because they vary depending on the amount of materials and the amount of labor. But overhead can be both fixed and variable. So a fixed cost that's overhead would be rent, because rent is fixed, it does not change given a relevant range, yet it's indirectly related to making the product, because remember, overhead is just a fancy way of saying indirect costs. The cost of cleaning supplies are not directly related to making the product, and so therefore it's an overhead cost, and it's variable because it depends on how many cleaning supplies you need. So they're telling us that fixed overhead cost is $500. They're telling us that total manufacturing overhead cost is $800. So we know that these two numbers need to add up to this. So obviously this is going to be $300 because 500 plus 300 is 800. You could have just done 800 minus 500, that gives you 300. Then we know that direct labor is 100. So we could figure out direct labor. And we know that total manufacturing cost is $1,000. We know that direct materials, direct labor, and overhead need to add up to 1,000. So I have 100, I have 800. So what am I missing? 100. Because 100 plus 100 plus 800 gives me 1,000. So now I know that I have $100 for direct labor and $800 for overhead, which is 1,000. No, I could have literally just taken this and put it in here. Or if there was $10 in beginning inventory, it would be 1,010. Total manufacturing cost is this part. So if I know that that's 1,000, then I could just add whatever the beginning inventory is and put that in here. But I always do this chart because you never know what they're going to ask. They could ask you specific things like fixed costs and variable costs. Or sometimes they can ask you what direct labor is, right? And I wouldn't have known that if I didn't do this chart. And they do, by the way, ask what direct labor is. This is 1,000. Debits and credits must be the same. So this is also 1,000. So 1,000 minus 200, that's 800. Because these credits have to add up. And if I add up the debits on the finished goods side, that's 200. Debits and credits must be the same. So this is also 200. 200 minus 100, that's 100. Because 100 plus 100 should give me 200. We never care about any of this. We just care about this, right? The cost of goods sold, that goes from here to here. Cost of goods sold is where it ends. That's as far as they will ask you. So now that we're done plugging in, we can actually answer the questions, go through this real quick. It's so easy. Variable manufacturing overhead cost for the year, we found that was $300. That's why the chart is useful. Direct manufacturing labor costs for the year, that was $100. It's just a fancy way of saying direct labor. Ending work in process inventory, that's $800, right? Because ending inventory, they're not asking you for the balance. Cost of goods available for sale, that's $200. Ending finished goods, that's $100. Let's say I asked you for direct material balance. At the end of the year, you would say 200. These here are the balances. These here are the inventories.